Okay. So good morning, everyone. This is it's 7 p.m. It's time to start. Okay, so morning fam, morning me. As you can see, I try without my headphone. Can you hear me the same quality, or is it better if I do you hear me well this evening, sorry? Okay, so I will try without, okay, because I think it's since we interact mostly with the chat. I don't need to hear a lot of things. I just need to okay, so it's the same. So even, thank you, Ha, for it's the same, because I'm not sure I have a mic on my it anyway. So maybe this is the mic of my computer. Okay, so welcome back to this session number 3 of investment decision. I'm very fine, thank you, Luong. I hope you are okay too, and that you had a nice weekend. So I was very happy yesterday to see that the video has been recording well. So as you know, I sent you an announcement through Canvas. So what I do is I host the video on my cloud in UQAM in Canada, because I have the size which is necessary, and so I just share the link with you. So yesterday I made a little mistake, so I stopped the recording and then I recorded again. So that's why you got 2 links for yesterday. So normally one day, one link. So we'll see. Maybe I do a mistake again, but globally, so it's recording, by the way, so it's okay. So it should be okay. Um, so okay, so let's come back to what we were doing yesterday before leaving. So I'm going to share the PDF documents. So you should see the slide, right? You should see the slide. And okay, let me organize my screen. Okay, so you should see this the problem that we were discussing yesterday. So let me remind you what was the topic about. The topic is about we talk about a loan, okay? And this loan is actually okay. We are 2 years after the beginning of the loan, okay? And so we know that we pay every month 2,623.33. So this is a constant payment, okay? And a constant payment every month. And so we are asked to know how much we firstly, how much is it left that we owe for the loan today. What is the remaining amount of the loan? Okay, so this one was easier because we know that from a previous exercise that the present value of the loan is the present value of all the amounts we still have to pay. Okay, so if we have a loan which is 28 years left to go, because we got 30 years and this is 2 years after, it means we got 28 years to go. So we can calculate easily the present value of the loan, the outstanding value of the loan, which is 28 years to go. Okay, so that was the first question. And then it was more tricky. It's to say how much interest did the firm pay on the loan in the last year. And so I stop sharing the PDF and I go back to the Excel. And this one. And so we have what we said here. So there's here who is sharing an answer. I'm just checking your answer just afterwards. So we said that the strategy here, and this is something I ask sometimes for the exam. So this exercise is good training for you. So we know that actually we pay the same amount every month. So and this is 2,623. Okay, so we have a total for 1 year, which is 12 times this amount. So we pay 31,479. Okay, and so we need to share that to split that into the part of the repayment and the part of the interest. Okay, and the strategy for this is firstly to calculate the part of the repayment. Doing so, how do we do that? We say, well, the part of the loan we repaid this year is actually the difference between the present value of the loan after 1 year and the present value of the loan after 2 years. Okay, so this is what was the strategy about. So let me check your results. So we have here that says, oh, okay, so yeah, I saw someone yesterday in the video that I record. So we have to be careful about that. In the video, we don't see the chat. Okay, so please have a look at the chat, but remember that the chat you will not be able to see it on the video. Okay, so here say that after 1 year we got 492. That's correct. After 2 years it's 484. That is correct. So reduction loan balance is 8,000. Okay, that's correct. And so the interest is 23,458, and we got the same thing for Kien. So let me applaud those two students here in Kien who both have the good answer. Perfect. So bravo to these two students. They work well during their Sunday time, right? And so yes, you exactly understood what it was about. So let me just copy and paste one of the solution that you give me, so I save time, and so everybody can see. Okay, so the balance after 1 year, so balance after 2 years. So this is what you have. Okay, so this is your calculation. So balance after 1 year, this is it. Okay, the difference, it's this one. Okay, just to link with what I said. And so, okay, so this is what we have. Sorry, for me, the system is with a comma, not a dot. It's my Excel is a French one, in the French version. So now I should be able to, okay, so this is what we have. So taking what I have here, so the part of the repayment, it's this one. So sorry, it's not okay. Okay, so we got this. Okay, and so the part of the interest is the difference between the two. 23 that we have here also, right? So it's correct. So bravo to the two students. So it's good for me because when I have students who find the right solution, it means it shows, it gives a good momentum to the group, and it shows also that we agree on the solution, and that you understood and everything. So this exercise is quite typical. So I think we will have the time later today to do one similar among the exercises of the interest chapter. But so let me summarize. So in the constant annuity system, okay, we know that we pay every month the same amount. So 2,623 in that case. So for 1 year, we pay 12 times this amount. Okay, so for 1 year, the total we pay is 31,479. And so the question was afterwards to say, what is a part of interest and what is a part of capital? So the first thing you have to do is to calculate the repayment in terms of capital first. And to do so, you have a tool that you can apply now that we studied together, which is the fact that we can calculate the present value of the loan at the beginning of the year, at the end of the year. Okay, so the difference between the amount we still owed after 1 year and the amount we owe after 2 years is 8,000. So that represents, of course, a part of capital that we repaid during the year. Okay, so it means that among the 31,479, the part of capital is 8,000, because as I say here in yellow, the annuity is made of only two things: a part of repayment of capital and a part of interest. Okay, so if we get the total of the annuities, if we can find the part which is linked to the repayment, okay, we can deduce um, as Kian was saying. So I'm just copying and pasting the second solution that was shared in the so interest paid is the difference between the total payment and the repayment. Okay, and the repayment is the difference of PV of a loan. So very well explained here. So I think it's better than me even. So you know, it's really what how you can understand this. So that's very typical. So that's very typical of what you can be asked. Why? Because this exercise is very useful for you students, because you can see that you don't have to make the entire schedule of the loan, the entire chart of the loan, right? You can already go like in the year 18 or in the year 15, whatever, and you can do this calculation very easily. And so because you can use the formula of the constant annuity and so on. Okay, so this kind of exercise, I like to ask it. You will see that certainly it will be something like that. There will in the exam of the previous year that I will share with you on Wednesday. You can see, because it's usually a way for me to see that you well understood this part. Okay, so that is what we can say about this exercise. And what it says also, so I don't know if you have any question about this exercise. I mean, of course, Hugh and Kian don't have questions because they have the answer. But what about the other ones, or the student? Maybe they want to know more or have a additional explanation. No? Okay, so let's move on. So the next thing that I would like to discuss with you is the fact that, you know, because I've been teaching this course for 8 years, I know now for a long time that in Vietnam, the system that you use is not the constant annuity system for the loans, it's more the constant repayment system. So let me just make an example here to compare the two systems. Okay, so let's say that we have a loan of, let's say, I don't know, 1 million or 100,000. We don't care. Let's not get embarrassed with the number. So 100,000 is enough. Okay, so we have a loan of 100,000, and let's say that the number of years is 5 years. Okay, so 5, and this is years. Okay, so for the moment, I'm going to quit very quickly the, you know, the fact that I work on a monthly basis, because here, this is not what I want to show. What I want to show is the difference between the two systems. Okay, so let's say that we have an interest rate of, I don't know, 10%. We don't care actually. Okay, rate. So, okay, and so the payment is the annual payments, okay? So firstly, let's work with the constant annuity system. So if we want to do so, we need already to calculate the annuity, right? So the annuity will be, so maybe you can calculate that for me. What would be the annuity, the constant annuity for this? So you work in parallel with me, and I'm gonna try to find it on my own as well. Maybe trying to use the problem is that I never remember the formula to use. I think this one. Okay, you can check. You can work on your side. Okay, that should be this. So I found it finally, but so I stop sharing so you don't see the answer. So please find me the annuity for this one. So 100,500, and maybe I can share. And So please share with me in the chat the answer. So what is the constant annuity for this one? Okay, so it's very easy. So the loan is 100,000, N is 5 years, rate is 10%. So it's a constant annuity. So again, now we have 100,000, which is equal to C divided by 0.1 multiplied by 1 minus 1 divided by 1.1 exponent 5. Okay. So what is C? So I wait for the answer in the chat. Okay, so I think, so here maybe there is a mistake somewhere. For Chang, I think you are correct. I think this is the right answer, 26,379. Here, your amount is too big because we have 100,000 already, so there must be a mistake in your calculation. 26 sounds more like something reasonable. You know, we pay 5 times 100,000, we get interest rate to pay, so we've paid 26 5 times, so it's okay. So here it's correct, but you have one zero too much. So it's 26,379. Yes, Anne, that is correct. 26,379. Waiting one more minute or two for people to be able to calculate. Do not hesitate to share in the chat so I can see that more people have found the right answer. So there is someone with the mic, so I'm gonna mute everyone. So Chang, there is a little mistake in your calculation, but okay for me, okay for Kian. So Chang, you should check. This is, you have on the board what you should apply. So maybe if I want to be more, I would say something like this. That's cleaner. That's cleaner. As you can see, the way I put the formula is always the formula I gave you, you know, I mean, you know, maybe this formula already, I'm sure you studied that in the past, but what I mean is that there is a direct formula that says C is equal to 100 times whatever. I don't know all, I know only one formula, which is you know, this one. And then, you know, once I know this one, I can navigate and, you know, put it in all the directions. It's enough for me. Okay, so I think we have some people, Liam, Chang, Deng 86, because I think we have a Deng 89 and a Deng 86. So we have two students with the same name, if I understood well. So that sounds nice, Deng 86, Deng 89, that sounds very nice. Sounds like a movie or something. And okay, so that being said, we have a lot of okay, so you 111 instead of 1.1. Okay, so at least you've been able to find what was the mistake in your calculation. So it's a good sign. It means that you master the formula. So okay, so now let's work on the, let me present you the chart of the amortization loans. Okay. So constant annuity amortization schedule, okay? I miss my word. There's a word that I miss here, but anyway. So we got the year. Okay, so that is 1, 2, 3, 4, 5. Okay, so we got the beginning amount. So let's say outstanding amount at the beginning. Okay. Then we're gonna have the interest, I think. Then we're gonna have the annuity, I think, and then the repayment and the outstanding balance at the end. Okay, that should be okay like this. Okay, so here we have the amount. Okay, so let's say that we do this and this, so it's cleaner. Okay, so here also. So obviously the beginning amount is of course 100,000 for the moment. Okay, so that's for the column 1. For the column 2 is of course, so let's say that this is the column 1. Okay, so let's call it 1. So that's column 1. So column 2 here is column 1, right, times the interest rate. Okay, because, sorry, times the interest rate. Sorry again, interest rate. Okay, so this times the rate. And let me put some dollars so I can drag the formula later on. Okay, 10,000. The annuity in the annuity system would be always the same. Sorry, I have to recalculate it because I forgot to put it again. So for me, it's not going to be very helpful for you, but for me, it's called VPM, but I don't remember how it's called in English. Maybe NPM, I don't know. A number of period, 5, and this. Okay, so okay, let me put it in absolute value for the moment. Okay, so this one, the annuity is equal to this one, and I'm not going to change the format because we don't care, but I put some dollars, so we have the amount that we can use. Okay, so the annuity is constant. Okay, so the repayment, so that's, let's say that's this column 3. So, and column 4 is the repayment, so it's column 3, right? The annuity minus the interest, so column 2. Okay, so this is what we did in the previous example. Okay, so that is this minus this, right? No, it's not what we did in the previous example. We did the opposite in the previous example. We calculate the interest out of the repayment. And so outstanding at the end, so that's the beginning amount that we owe minus the repayment, okay? So that should be okay, I guess. That should be okay. And so, of course, the beginning amount of the year 2 is the ending amount of the year 1, right? And that should be okay now. I should be able to drag my, my formula. Yes, it must be correct because as you can see, I have 0 at the end of the loan. And so, okay, so we have these amounts. Okay, so we have 100,000, and then we go down to 0. Okay, and so we pay interest 10% out of the beginning amount each time. Okay, and that's it. So we can see here that, of course, with the constant annuity amortization schedule, what is constant is in yellow now, it's the amount of the annuity. So it's not what you do normally in Vietnam. Okay, so I think people who work in banks know that this is not what they use. And maybe if you as a person, maybe as a family person, I mean, maybe you know, you borrowed some money to the bank, maybe to buy a place or so, to buy a car or a motorbike or whatever. You you can you know this system, because this system is what we use in France. Okay, this is what they use in the US as well. And also this is what they use in Canada, because now I'm in Canada, so I can tell. There are some difference between France and Canada, but it's not about the system. It's about something else that we can discuss later if you want. Okay? And so the other system that we can talk about is a constant repayment, okay, system. So in that case, let's put it in a different color. Let's say blue. Okay, so this one, no color anymore. So in that system, what is constant is the repayment. Okay, so the amount of repayment every year. Okay, so the repayment will be equal to the amount of money we borrowed, okay, divided by the number of years. So that means, and this is more what you guys do in Vietnam, if I know well, you can share with me in the chat if it's different now, or if you agree or disagree about your experience. So what is constant now is not the amount of the annuity, but the amount of the repayment. Okay, so we have still the beginning amount, which is the same. Okay, the repayment is the same, and so the interest is calculated the same. Okay, but so the annuity now is changing. So the annuity now is 2 plus 4. Okay, and the repayment is loan divided by number of years. Okay, so the annuity is equal to this plus this. And so this is how it works. Okay. So if I'm not mistaken, yeah, should be okay. We can see that in the first system. Totally agree with you, Prof. Thank you, Ha. So okay, I'm happy to see that it's still the same. So it's just for you to have more and let's say a possibility to compare Vietnam with other countries. And I'm sure that some of you guys work in international companies or would like to work in international companies. So that's why maybe you do the MEBF as well. So it's good you know the different systems and that you are able to understand the differences. Okay, so this is why I wanted to share with you the schedule. And this is, I think, Anne, who asked me yesterday to share my draft Excel file that I did, right? You have it on the canvas now. So as you can see, maybe, I don't know if you see the name of my file, but now I called it Idbv. So in the investment decision basic video Blackboard, Sunday, December 6th. So I will share again today my Excel that I use. So you will be able to see that also. But of course, I invite you to try to do it by yourself, because it's important to do it by yourself if you want to understand. I will not share always my Excel files. Sometimes I don't want to share because I want you to do it on your own, but this one is okay. So coming back to the example, so we have the two systems that we can compare. So we got the annuity system. So yellow is the column which is fixed. Okay, the column which is in the column which is in the color is the one which is fixed. So constant annuity, what is that? What is constant? It's the annuity. Okay, constant repayment, what is constant? It's the repayment. Okay, and so we can see the difference here. So if we compare, and just very quickly, we can see that normally we should pay more interest in the constant annuity system. Yes, we do. Okay, we can see we pay 31 here versus 30,000 here. So that's why sometimes banks would like to prefer the constant annuity system, because at the end of the process, you have more interest which is paid. And we can see also that in the beginning, we have, less repayment here in this system, in the constant annuity system, compared to to the to the repayment system. Okay. But if I'm not mistaken, the annuities are higher in the second system. Okay, so we have pros and cons for the two systems. Afterwards, it depends on other topics. So maybe it's a cultural issue, maybe it's due to the inflation as well, and the fact that the rates are fluctuating very much. There's certainly more inflation in Vietnam than in Europe, or in the North America, at least for a few decades now. So certainly has something to do with it. Then afterwards, it depends. What banks can do also is how long they fix the rate. Okay. For example, in France, when you borrow money to buy your apartment, for example, now I would say that now you borrow for 20 or 25 years. Okay, before the crisis, 2008, people usually they were using 15 years. Now it's 20, 25 years, because maybe it's more expensive to buy a house and everything. And when you negotiate with the bank, you usually negotiate a fixed rate, okay, for your loan, and the rate is fixed for 20 or 25 years. Okay, so that's quite interesting. So that's why, like a few years ago after the crisis, 2008, a lot of people in France renegotiated with the bank their loans, because the loans were having a very high rate. And because the rates were lower, they say, okay, let's negotiate a lower rate. Okay. And so now they have a very low rate for 20 years to 10 years for the rest of the life of their loan, which is very interesting, of course. Not for the bank, but for the customers. In Canada, for example, but in the US, they don't change for early payment fee. However, in Vietnam, they charge customer for prepaid fee, pretty close to the difference between the two systems. So you mean that the fee that is charged to the customer compensate the difference between the systems, sort of, huh? Yeah, okay, so I see. So, but of course they will try to find a way. In Canada, because I've been negotiating with banks, it's different. The system is different. You can choose a floating rate or a fixed rate. Of course, usually now the rates are very low, so they are higher in Canada than in France, but they are very low. And when you negotiate a rate with the bank, let's say you negotiate a fixed rate, so they don't give you a fixed rate for 15 or 20 years or 25 years. Nowadays, you can negotiate a fixed rate for 7 years. Okay, so it means that if you borrow money for 20 or 25 years, you are your rate, your rate for the first years, and then you have to renegotiate the rate. Okay, so the banks are trying to having a sort of an intermediary system when they protect themselves. Okay, they don't want people to have low rates for 25 years if the rates are going up, right? Or if the inflation is going up. So you have 7 years, and then afterwards you negotiate. And as I was saying about the early payment fee, yes, in Canada, there is no early payment fee as well. You have, to some extent, you can pay back more than what is expected to some extent every year and so on, as a compensation to the fact that the rate is not fixed. Okay, so I would say that in France, you would have to pay a payment fee, which is quite large. You have to negotiate with the bank, but if you want to anticipate the payment on your loan, you will have some fees. But on the other hand, your rate is fixed for 25 years. Okay, so the risk about the rate does not exist anymore, and for the bank, it's not very sexy. On the other hand, so in Canada, for example, you have the rate which is fixed for only 7 years, but you have a lot of systems where you can pay back by anticipation a large part of your loan during these 7 years. Okay, so that limits, of course, the risk for the bank as well, for you not to pay. And for you, it's also for you as a person, as a customer, it's an incentive, of course, to pay back quicker what you have. Okay, so maybe maybe if you know a little bit. So usually, I don't know if you want to talk or if you want just to write it down in the chat, but if it's easier for you to open your mic, you can. If you don't, you're not obliged to. But my question would be, in Vietnam, so you have the constant repayment system, okay, normally. So do the rates are more like fixed rates or variable rates? What is the most common situation? Or how, or someone else, huh? So maybe Ha is not there anymore, didn't hear my question. Okay, so it's fixed for 1 or 2 years and floating. Okay, and so people can, are you working in a bank? And so here say we usually will use float rate 24 months deposit rate plus 3.5. Okay, floating rate is more common than fixed rate. Okay, for long-term loan. Okay, with the constant repayment system, right? So we got a floating rate, but with a constant repayment system, I guess. That would make sense for me. Yeah, okay. Thank you very much for your insights. It's always good for me to know. Okay, so these are the difference between the two systems, okay, for those of you guys who are not familiar with it. So I wanted to share that with you. So I'm going to quit the Excel and come back to the to the PDF document. Okay, so this is a official solution. So I will provide you with that. Huh? And so we are done with the first part of the chapter about interest rates, which is about the calculations. If you remember yesterday what I said, in this chapter we have two parts. The first part is about calculations. So we did the calculations. Now it's more about, talking about economics, about the interest rates. So this is why we're going to talk about what we call the determinants of the interest rates. So we're going to just discuss quite quickly what are the elements that can influence the level of the interest rate. Okay, so that's important for you to know. Of course, the first is inflation. Inflation is the first, right? It means that the higher the inflation is, the higher will be the rate of the bank. Okay. So to be able to discuss that, usually we have what we call the nominal rate, okay, which is a rate we discuss, and then what we call the real interest rate. It's the rate, the nominal rate minus the inflation. Okay, so usually this is what we can say, the real interest rate, to make it simple. So we get a formula by this model is by Fisher, I think, the economist Fisher. So, but to make it simple, we can say that the real interest rate is the nominal rate that we called R so far minus inflation rate. Okay, so we can discuss this. So I don't know if you have in your slides the solution to this one. So let's say at the start of 2011, 1 year US government bonds rates were about 0.3, while the rate of inflation was 3%, okay? And in May of 2014, 1 year interest rate were about 0.1, and inflation was about minus 0.5. What was the real interest rate in 2011 and 2014? So if I go in Excel, I think it's quite easy to understand. So in 2011, I don't remember if you have the solution, if I led the solution to this one. So R and I, okay. So R was 0.3% and the inflation was 3. Okay, so the real interest rate was negative. This is what we want to show here. Okay, so the real interest rate was negative during this 2011 because of you know, the crisis situation. So normally it should not happen, but it happens sometimes. It's like you remember one of you said to me, in the growing perpetuity formula, you say, what happens if R is lower than G? And I said, you know, normally it doesn't happen, but it can happen sometimes. So this is it. 2011, you know, crisis moment, you have this situation. And so for 2014, according to the case, we have 0.1% and minus 0.05 for minus 0.5. Sorry. So up, no, so minus 0.05. Okay, so the real interest rate was positive 0.15. Okay, which looks like a little bit more what is the current situation. Okay, so that's for the US. Okay, it's just to show. And maybe we can, I was checking just before the class the situation in Vietnam. So I found some information online. So let me share with you. And I'm gonna try to share my Safari. Voilà. This is it. So you must see my Safari now. So here you got the interest rates in Vietnam over, I think I chose 25 years or something like this, okay? And so we can see that I maybe you certainly studied that, but I think the worst moment was August 2008, if I remember well. And so in that case, it was like, so the highest is 15%. So we are here, you can see, right? So let's say I'm going to write it down on the Excel, but I will come back on the Excel later on. Can you see my Safari? Can you see the chart on Safari? So that's 2008. I think it's August 2008. I'm just checking. So that's the rate was 15%. And so 15% in 2008, and now it must be, it seems to be nowadays, it's, yeah, actually it's 4. Okay, so actually it's 4. So now, so let's call it actual. And you have a second chart, which is about inflation. And so for inflation, we can see here the highest was 28.24, same thing in 2008. So let's say 28. Okay. And actual is 1.48. Okay, 1.48. Okay. So the this is a link, huh? This is a link. Sorry, I didn't double check if the source is correct, but it seems to be quite a good source. So I'm sorry, I'm trying to escape from, okay, arrêtez de partager. Okay, so now I'm coming back on my Excel file. And so you must see that. So for Vietnam now, so August 2008, okay, so the real interest rate was negative. That was the worst moment for that topic. So we had a real interest rate which was negative, minus 13, and now today, okay, we have a more typical situation with 4% for the rate and 1.48 for the inflation. So I don't remember the rate I chose, but I think it was a 10 years rate or something like this. But anyways, just to give you an idea about this, and the fact that the bottom line of this is that the inflation has an influence on the level of the rate, and normally the rate will be inflation plus a premium, okay? And in some crisis moment, like August 2008 for Vietnam, or like 2011 for the US, we have some negative rates because we have a very untypical scenario. Okay, any question about this in the chat? No? Okay, so let's move on. So I come back to my PDF document. Tell me, huh? Normally you should see my my PDF document now. Okay, so that's, yeah, so the first determinant of the interest rate is inflation. Okay, and so there is one chart also which is quite interesting here to see. Here we compare, so it's in the US, but you know, it's because unfortunately your book, the Berg de Marzo book that we use, is based on the US. But I mean, I'm French and I work with US data as well, because you know we all follow the lead of this book. So unfortunately we work on US data. But maybe I will try to show some European data later on when we talk about bonds and everything. Okay, so here this chart is quite interesting because we see, so the blue line is the nominal interest rate, okay? And the red line is about the inflation rate. So what we can see, I guess, usually I ask you questions, but it's not easy with the chat. Usually what is interesting to see in this PDF is freezing, okay. Is it okay now? Okay. So thank you for telling me. So yes, what I wanted to show you here in this chart, so let me rephrase it then if it was freezing. So we get the blue line that represent the interest rates, okay? And we get the red line that represent inflation. So we can see clearly the first thing which is very important is to see what we call the correlation, right? The correlation between the two. So it means that that seems to be influenced by one another. I would say that the blue line is influenced by the red line, okay? And the normal situation is that the blue line is higher than the red line, meaning that the interest rate, the real interest rate is inflation plus a premium, which makes sense, okay? Which we just calculated. That makes sense. I mean, the bank want to earn some money, okay? So the interest rate on the loan will be the cost of the purchasing power, inflation, plus a premium which represent, let's say, the service which is rendered by the bank. Okay, this, you know, you have to earn money. And okay, so the blue line is usually higher than the red line. Okay, so you get it. And so there is a strong correlation. And also you can see that some moments like here, and sorry, like here, some small moments during which we have the red line, which is higher than the blue line. And here it's even better, I think, this one, because we can see that, sorry, they move together, okay, but the red line seems to move before the blue line, okay? So firstly, here, 74, it's the first oil shock, okay? So crisis moment. 78, second oil shock, crisis moment. Here, 2008 crisis, another crisis. So the moment when we have, we have the red line, meaning inflation, which is higher than the interest rate, it's usually when you have crisis. Okay, so that's the first thing. And we can see here clearly, very interesting, is that the red curve is going up and then the blue curve adapt. Okay, what does it mean? it means that inflation will go up first, and then banks will adapt their interest rates to the new situation. So sometimes it takes a little bit of a time lag between the two. Okay, so the blue line is really reacting to the red line. Okay, so it means that the rate of the bank will be adapted to the situation of the inflation. Okay, so globally, this is what we can say about this. So I would say in a statistical vocabulary that we have correlation because they move together, they tend to move together. And we also have causality because it seems that it's the level of inflation that will influence the level of the interest rate. Okay, so I think this is what we can say here. Okay, so normal situation, loan rates will be higher than inflation, and usually, and sometimes during crisis moments, you will have a moment during which, wow, it's the opposite, and the bank will take a little time to adapt. So very interesting to see how it interacts. And clearly, bottom line of this, the first determinant of the interest rate is inflation. Okay? Any question about this? No? Okay, so let's move on. Second determinant of the interest rates is the interest rate policy. Okay, so decision made by governments and federal banks to central banks to influence the level of interest. Okay, so interest rate influencing the level of interest rate by the central banks is a tool to help economy. Okay, so why is it helpful for the economy? This is maybe the question we could. I'm not an economist, huh? So I'm gonna tell you that with my understanding as a financial person, but still. So I will use NPV to discuss that with you. So you remember we calculated an NPV, okay, and we did an exercise together when we calculated the NPV with two different discount rates, and I told you bottom line of this is that the higher the discount rate, the lower the NPV. Okay, so when the rates are higher, the NPV will be lower. So if we take in this case an NPV of an investment for which we use a rate of 5%. So normally, please let me add here that we should not use the interest rate as a discount rate. Okay, sorry, because it says the opposite. The interest rate is 5%. We should not use interest rate as a discount rate. But of course, the discount rate would be maybe influenced by the level of interest rate, right? When you want to have a rate of return for an investment, it would be maybe higher if the situation of the interest is higher or not. So let's consider that we can apply that here. So when the situation on the market is about 5%, the NPV of the project will be 0.63. It's positive, okay? What happens if the interest rate go up? Well, of course, if the interest is now 9% instead of 5%, the NPV is lower, right? It's it was 0.63 before, and it's 0.28 after. So what does it mean? It means that if a government want to push companies to invest, maybe they're gonna try to make it less expensive, the interest rates, lower the interest rates, okay? So it's less expensive to borrow money, so we can have a better NPV for a project, okay? So in which situation should we use interest rate as a discount rate? Normally never. So only, or let's say only for loans. Only for loans, okay? But usually the discount rate can be calculated based on the interest rate. Like if we use, you will learn that with my colleague in January, or I don't know when, but with Pramwan Bunkanawisha, because the discount rate is usually interest rate plus premium, okay, or the discount rate will be equal to mix average of interest rate and equity rate. Okay, this is what we call the WACC, the weighted average cost of capital. So what I mean is that, okay, sorry, my discount rate is interest rate plus premium, or discount rate is equal to average, so average of interest rate and equity rate. Sorry, that's better this way. Okay. So you should not use. So what I mean, okay, sorry, maybe I've been a little bit too hush on the way to say it when I say never. What I mean is that the discount rate that you will use for a project, like when you have an investment, for example, it should be the return you expect from that investment. Okay. And the return you expect from this investment is usually linked to the return you expect for one asset. Okay, so it's usually quite risky, because when you invest in an asset, you know, it's difficult. So it will be certainly higher than the interest rate. Okay, so you shouldn't use the interest rate as a discount rate. But sometimes to calculate the cost or the return expected for one asset, you will use an average mix of the cost for loans and the cost for equity. Okay, so this is what we call the WACC, the weighted average cost of capital. And this, yes, actually we're gonna discuss the premium in a few seconds. If you, okay, so you give me 1 minute, okay? I'm gonna check maybe in my slides 1 or 2 explanations I can give you, but I will not go further because this is something you will study in another course, okay? So I'm just gonna introduce, okay? And then from there, I will let you work on this with my colleague later on. Okay, just give me 1 second, huh? Checking documents here. Okay. Where should it be? No, I can't. Okay, it's not. It's gonna take time, so I don't want to get into the details for the WACC. For the premium, I can get into the details because we're gonna discuss this in a few seconds. So here for the premium, it's gonna come in a few slides. Okay. Okay, so let's discuss something else then. Let's talk about what we call the yield curve. The yield curve is the yield curve is the curve of the rates which are offered by the market at one moment in time. Okay, so we can plot that into a graph like this. So this graph is from the book and it's quite interesting. So it's the risk-free US interest rates which are offered on the market depending on the maturity. Okay, so you get the maturity here. And you got 3 moments in time. Okay, so what you have to understand here is that it's like when it's blue, okay, it's like you are in November 2006, okay, and you arrive on the market and you look at what are the rates which are offered by the market. And you can see that if you borrow money or if you buy bonds or whatever, which are risk-free, for 6 months, you're gonna earn 5.23. Okay, so this is here. For 1 year, it's going to be 4.99 and so on. And then for the long term, if you borrow or if you buy for 20 years, it's going to be 4.87. Okay, like this. So that's the first situation. So that's November. So remember about the crisis and everything, right? So the first thing that's November 2006. So the second moment is you arrive. This is November 2007, and you arrive on the market and you have a look at the rates which are offered. So here it's yellow. So if you borrow money for 6 months, it's 3.32. Or if you invest, you're going to earn 3.32. Okay. For 6 months, 3.16 for 1 year. And for 20 years, it's 4.45. So it's here. Third moment, you are in November 2008 now. You arrive in the markets, and you have the red rates which are offered to you. So if you borrow, or if you borrow money for 6 months, it's gonna cost 0.47, or if you invest, you're gonna earn 0.47. For 1 year, 0.91, and so on, and 3.87 for the long run. Okay. So how do you? So remember, it's risk-free assets that you could buy or sell. So in your opinion, what happened? Why do we have difference for the short term? Is there somebody would like to try to explain why do we have higher rates? Or what if you had this chart to comment, what would you say? I think there are two things that we could say. I don't know if you want to try. I'll let you 30 seconds. If I have no answer, I will give you my comment, but you can try if you want. Okay, so I'm gonna explain myself then. Firstly, usually when I'm with you in Vietnam and I'm in the room with you, I can see your faces. So I try to find someone who would like to answer to this question. Usually students, they say two typical things. They say, we can see that there is the big difference is for the short term, because for the long term, there is not so much difference. So it fluctuates following to the inflation rate. We are at one moment in time, right? So yes, it can influence, but why do we have differences for the short term and the long term? That would be a difference. Yes, of course, we have the interest rate, the inflation rate that influences, but why do we have a higher level in the short term compared to the long term? That's also what we could say. So, okay, so what happens on the short term is what we see here, the difference here is actually due to the action of central banks, because central banks can influence the level of the rates, and especially for the short term. If you want to create a shock in the economy to help the economy to get better, especially in a crisis moment, and if you are a central bank, what you can do is maybe try to influence the level of short-term interest rates. And if you lower them the way it is, okay, it means that you will try to make the NPV better, as we saw in the calculation just before. Okay, so that's a way you can do it. Another way to put it is that it's not very normal. This is what we call an upper tail curve, right? It's not very normal that you have higher rates for the short term than for the long term. Okay, it's better. I think it's more understandable to say that we have lower rates for the short term than for the long term, because you would like to reward maturity as well, right? The number of years. Okay, so since we are talking about risk-free products, it's not a difference in difference in risk. And to answer to the question by Trung, I think the inflation we can see is the difference between the where the curve are in the graph, right? If we correct from inflation, maybe we will be at the exactly the same, okay, but except that for the short term it will still remain different here, okay. So that's the inflation remark is quite interesting, because that would say that if we correct for inflation, my guess is that the red curve would be around the yellow curve, and the blue, so for the long term they would be the same at the same level, and we would see only a difference for the short term. So that would show even more focus on the fact that the short term is influenced by the policy of the central banks, okay. So I don't care about this, okay. So sometimes I ask about the determinants of the interest rates in the exam. So what are the determinants? Inflation, okay? So central bank policies, maturity, the number of years, okay? Maturity, number of years. And another one would be, so we have three of them, and another one would be, okay, I'm gonna forget the taxes, but you can have a look at what they say in the book, but taxes. But the other one is the risk. And this is when I'm gonna be able to answer to hear about the premium, okay? So this is now we talk about it. So the risk will influence the level of the interest rates. So you will not have the same interest rate if it's a risky product or if it's not a risky product, okay? So usually we try to identify what we call risk-free products. So risk-free products will be, for example, US Treasury securities, okay? Because we consider that the US government is able always to pay back its debt, okay? So the risk we are talking about here is the risk of default, okay? The risk that the person will not be able to pay. Okay, so it means that the higher the risk that the person will not pay, the higher would be the interest rate, okay? So it's like for you or for me, if we go to the bank to borrow money, maybe we will not have the same rate, because the bank will analyze our personal situation and say, okay, this person is more risky because the job is not so stable, or because there is only one salary in the family, or because they don't have a lot of savings, or because we can see the history in the bank accounts, there have been ups and downs and so on. On the opposite, people will have a better reputation because they come from a rich family and so on. So of course we are all different, right? When it comes to the rate we can hope from the bank. And of course companies, this is the same, right? And so globally companies or governments, okay? So of course in the US government will be considered as risk-free, okay? So, and this is, I think, here where I answer to your question about the premium. This is now, because here you can see that, for example, in July 2015, we don't care, right? So it's 5 years loan borrowings for different people. So what is the rate that's going to be paid by the people regarding who they are? So US Treasuries, they will pay, so the US government, they will pay 1.7. So this is the risk-free rate, okay? And so then we can see that when we go for companies, Johnson & Johnson, McDonald's, Xerox, Tupperware, Gap, and so on, we can see that we go from 1.7 to, in that case, 4.9. So what would be the premium? Well, the premium for Gap would be certainly 4.9 minus 1.7, right? So that's 3.2 if I'm not mistaken. So that's the premium. That's actually the risk premium. Okay, so this is a risk premium for Gap. So Gap will pay higher rate compared to US government because markets consider that it's more risky. And you can see that it will depend on the company. Globally, will depend on different things, right? Firstly, will depend on the industry. Okay, some industries are more risky than others. And it will depend on the company as well. So this is also something you will study with Pramwan Bunkanawisha, my colleague from ESCP, excellent professor, excellent researcher, very, very, very good professor. And so he will explain to you that these cases are linked to different models that we can use. So to measure the risk. So how to measure the risk? So it's not my course, but you have one model which is called the CAPM. So capital asset pricing model. Sorry. So you can have a look. It's chapter 10 to 12 of the book. Okay, if you want to know more about this, but you will study that with Pramwan, so no, don't worry about that. But what you will study at the time, it's to get into more details for this premium, how it's calculated, how can we calculate it, okay? And we will reach something, a first concept, which is it a systematic risk or is it an unsystematic risk? Okay, so systematic risk is a risk which is affecting everyone at the same time. Let's say that the COVID, for example, we can see that, you can be Johnson Johnson, Gap, or you can be Vietnam Airlines, or you can be everyone, you will be affected by the COVID. Okay, so that's a systematic risk. And then if you are Vietnam Airlines, maybe you will be more affected than if you are a bank, because during the COVID times, you cannot fly, right? So there will be a risk which is not systematic, which is not, let's say, applied to everyone at the same time, but that will be depending on your industry. Some industry will become more risky than others with the COVID. Tourism industry, airline industries, and so on are becoming more risky, right? Because people, these industries do not work anymore. Okay, and so this is how we're going to determine the premium, the risk premium. It's going to be linked to the global situation, to the industry of the company, and to the company itself. Okay, so this is maybe how we can determine this premium. And so you will use several models to do so, among which the capital asset pricing model, that will help you to measure that on the market. And so that will help you also to find also the discount rate you can use for one company. Okay, and so that's why when I was trying to answer to why do we not use the interest rate as a discount rate, because what we will use is the rate which is linked to the industry or to the company, that we will determine with the capital asset pricing model. And this will be also linked to the interest rate, but plus the premium that will be different from one company to the other. So maybe considering where we are in the MEBF program, the answer I can give you to why can't we use discount rate, interest rate as discount rate, I would say you can use it if you add a premium, okay? And the premium will be linked to the risky situation of the company, to make it simple. Okay, thank you. Do you have any other questions about this one? Coming back to the interest rate policy, why does the central bank choose to control the short-term rate instead of long-term one? Because they want to create a shock, and they want the reaction to be very fast, because they want the changes to happen very fast, right? So they will influence they think long-term, will, find an equilibrium by itself. What they want to influence is the short term. They want people to take decisions now, to invest now, because the rates for the short term are not very expensive. So company will invest, because I mute everyone, because what they want to do is that okay, they want to influence the level of investment of company now on the short term, because lower short-term rates, more investment now, more jobs tomorrow. Okay. Different customer, different credit scoring. Yes, so we will rediscuss that, I think, in the bond chapter, where we, you're welcome. Um, um, yes, so the scoring, we will talk about it in the next chapter when we talk about the bonds. Okay, but of course, what we can say now is that to measure the risk of a company or of a bond or whatever, there have been some scoring agencies that have been developed, okay, to give some ratings to some companies, or maybe not to the companies, but to the bonds that are issued by the companies, right? Because when a company issues some bonds, it means that the company issues some debt on the market, okay? And of course, people who would like to buy those bonds that will become the bank of the company, they would like to know what is the level of risk they are taking. And according to that, the higher the risk they are taking, the higher will be the rate they ask for the bond, right? Because they want to be compensated with the risk. So it means that you can see that at two sides of the mirror. If you are the company and you borrow money, so if you are a risky company, of course, the interest rate that will be required for you will be higher, right? We will ask you a higher rate because you're a risky person or a risky company. On the other side of the mirror, if you are the person who's going to buy bonds of this company, okay, you would like to earn money, and you would like to earn money according to the risk you are taking, right? So it means that if you buy bonds of gap, you should wait for, you should expect to receive a higher interest rate than if you buy bonds from the US government, right? And so if we are talking here about just you as an individual or me as an individual, if I want to save money, but not on the saving account, but invest on the markets, right? Maybe I would choose between buying bond gaps and US Treasury gaps according to what I want to do with my money. If I want, to earn less, but, take no risk, I will just buy US Treasury bonds. And, if I'm this moment when, okay, 1.7 is not enough for me because, it's not big, I prefer to take a little bit more risk. So I'm going to buy bonds of Gap. I like this company, Gap. So, I like this company. So I'm going to buy these bonds of this company and I will earn 4.9, right? And so it's going to get better for me. And so maybe it's risky, but it's not so risky. So I can go for it. Because, of course, the risk here is that you never paid, right? In Europe, we had this problem with the Greek government. But we discuss that when we talk about the bonds. You're welcome, Anne. Okay, so let me check what we have afterwards. So, yeah. So this one, thank you here. So this one we discussed already, the opportunity cost of capital. So let me just let me check the best available expected rate of return offered in the market of an investment company. Okay, let's get the cost of capital. Okay, so what we can do now, we are finished with the theory about interest rates. So now we're gonna have some time to do some exercises, okay? And so maybe we can have the break now. And so we come back in 20 minutes. And in between, maybe I will gonna try to find 1 or 2 slides about the cost of capital so I can explain you better. Is that okay for everyone? So if it's okay for you, it's like 8:20. So yes, okay, so it's 8:20. So we come back in 20 minutes. So 8:40, we come back and we do some exercises, okay? So if you have dinner, enjoy your dinner or enjoy your break and see you in 20 minutes. Okay, so we are back to for the second part of the course. Can you just so at least one person in the chat confirm that you hear me well? So because okay, thank you very much, Ian. Um, all right, so yes, so let me. So coming back to the the question about why do we don't use the discount rate in as a sorry, the interest rate as a discount rate. I said a few things already. I found finally the slide I was thinking about, which is from the chapter 12 of the book. Okay, so it's maybe it's not the last version, so maybe it's not the figure 12.3, but just check around. Again, this is something you will study in another course. The chapter is called the cost of capital. So this is something we don't study together. You study that with Pram 1, Bunkana Wisha. So in the course called FSS, so Financial Structure and Strategies, I guess. I've been teaching that once. I replaced Pram 1 who could not get to Vietnam. So I've been teaching, and I've been teaching this course actually in Paris for many times. So just to introduce you with the topic, because you will again study that later. Um, so and it I insist on this because that's going to be useful for your group work. Okay, group work. What is the discount rate you should use for your group work? This is what you should use. The return, the discount rate is the return you expect from your project. Okay, and so the return you expect from your project is the return that your company expects from the assets. Okay, so usually what you can do is to say, what is the discount rate I should use for my project, like in the group work again, okay, is actually the return which is expected for the assets of my company already. Okay, so the first thing is to maybe try to find what we call a comparable. So it means that you try to find somewhere else what we call an opportunity cost of capital, which is actually the rate of return which is normally used for that kind of project. Okay, so that's the first way to think about it, to try to find around you guys, like I don't know, somewhere like in a in a statistical study or whatever. You try to find the return of the normal return for the assets of that kind of industry, so you can use it. So you can find for that competition from the competition, comparable firm, and so on. If not, you can maybe try for your firm to say the return on my assets should be actually the average between the return which is expected by the debt holders and the return which is expected by the equity holders. And so you make sort of an average, which is called the weighted average cost of capital, which is actually the average between the cost of debt and the cost of equity. And so, of course, when we talk about the cost of debt here, we're talking about the interest rate, okay? So in that case, we would use the interest rate, but only as a part of the calculation, okay? We would take the average between the interest rate and the return which is expected by the shareholders, which is usually higher. But it's not expected for you for my course to know how to calculate that. I just want you to remember this, and that the fact that when you use the discount rate in your group work, you have to think about what is the return which is expected for that kind of asset. Okay, so maybe try to avoid in the group work, when you explain your choice of the discount rate you use, maybe try to avoid to use interest rate, okay? Because it's not good to use interest rate for the assets, okay? You can use interest rate plus a premium, then you explain why you have such a premium and so on, That's okay. That's fair. You say, okay, I know that for when there is no risk, this is interest rate 4%, but my asset is more risky because I invest in a machine. I'm not sure it's gonna earn money, so I have to ask to add a premium. So we have been searching online, and the premium should be around this and this. So we take a sort of a range, minimum, maximum, and we make a study or something like this. That could work. The other way is just to try to find somewhere else a typical return on assets for that kind of project. But we will have the opportunity to discuss that when we talk about capital budgeting. Okay. So already, do you have any question or comment to do about this additional explanation? Sorry. No comment. Okay. No further comment for me. Okay. Thank you. Thank you very much for asking. So I think now we can move to do some exercises. Okay, so please open the interest rates exercises file that you have in your PDF. Okay, thank you, Tri. So I chose exercise number 2, exercise number 6, and exercise number 8. Okay, so you have 3 exercises to do. And so we do like yesterday. So you train. These are good training for the exam. So you train. You can share the answer in the chat. I share the solution with you, and then we move on to the next chapter afterwards. So I let you a few minutes. Exercise 2, 6, 8 in the PDF file called interest rate exercises. Okay, so that's perfect. So Kian has the good answers for the exercise number 2. So bravo, you can move to 6, number 6, and so of course we wait for. So 3, you have yeah, that's correct as well. So yeah, for here, that's correct as well. We got all the details. That's nice. I give 2 more minutes and I show the solution. Okay, so I think it's time now to share the result, because we have a few students who have this already. You know what? I give you 2 or 3 more minutes, because um, I want to give some more time for the other ones to finish. Yes, that is correct as well. I don't know, Chang, why you have 10.25, because but the second line is correct, 10.47. So 10.25, I don't know why. So for Ha, this is correct. Okay. So I think we can look at the solution now. So here, so be with me for 1 minute or two so I explain. Okay, so this exercise is to work on the, the EAR, APR aspect that we discussed, I think it was yesterday, and to recalculate what is the corresponding EAR to the APR we use. Okay, so if we use a 10% APR with monthly compounding, okay, so it means that we're going to use 10% divided by 12, okay, every month. And so when we want to recalculate that on a yearly basis, we're going to do 1 plus this rate, exponent 12, okay, minus 1 actually. Huh? And so we miss a minus 1 here. I don't know if, no, I cannot write, okay, because a PDF, okay. So yes, I can modifier, tiens, tu vas voir, yes, I can, minus 1, okay, we can. But it's not very nice because it's not in the formula. Okay, so, okay, fermé. So the first rate is 10.47, okay? So what does it mean? It means that, bravo me, it means that when people say you're going to pay 10%, but you do it on a monthly basis using an APR, finally you pay 10.47, okay? For $1 invested in an account, 10% APR with annual compounding, of course, even no calculation to do if you understand well, because the rhythm of compounding is the same for the compound interest and the simple interest for the APR and the EAR. So it's 0.1 exponent 1, okay? So it's 10%, it's the same. So there is no difference, okay? The rate is the same because the rhythm of compounding is the same. And for the last one, it's a 9% APR with daily compounding, okay? So we do 9%, sorry, 9% divided by 365, okay? And when we do that 1 plus this exponent 365, we find 9.416, okay? So so I think we compute the EAR for each investment choice. They don't ask you, but certainly you want to take the best opportunity for you. So it seems that the best opportunity for you is the first one. If you invest, right? If your investment, so you earn the amount, I think the best solution is for you the first one, because this is the highest rate. Okay, so that was for you know to discuss the to discuss the EAR APR thing. So do you have any question about this exercise number 2 or any comment? I see a lot of students with good answers. So that's seems good for me. No comment in the chat. No question in the chat. So okay, so now the next things to do is a 6. Okay, so you have just purchased a home, taken out $500,000 mortgage. Mortgage is 30 years term, monthly payments, APR 6%, so monthly payments, right? And APR of 6, okay? And then, so the first thing you have to do is to calculate the monthly annuity. And so how much will you pay in interest and how much will you pay in principal during the first year? And how much you will pay in interest and how much you will pay in principal during the 20th year, meaning between 19 and year 19, year 20, okay? So of course that is echoing to what we what we did together at the beginning of the session, okay? So I'll let you a few minutes to do it. You can share your answers in the chat, and so I'll let you try to do it by yourself, and I give the solution in a few minutes. Um, it seems to be yeah, it's more than that. It's more than that. Interest the first year it's 29. Yeah. So just to react to what Ian is saying, because he took another option for the calculation. He used the if you have a look at what we say in the chat, so the calculations here made were correct, but he used a monthly EAR instead of monthly APR. So I said to him that was a mistake compared to the official solution. And he said, yes, but it's not clear. It's not clearly said that we should use the monthly APR, the monthly APR. It's not said. It's sort of induced because we say the mortgage has 30 years term with monthly payment and an APR of 6%. So usually this is what happens. When you see APR in the text, you must understand that it's the APR that they use, right? If they don't, they would say EAR. So they say, it's true that they don't say clearly it's a monthly with APR with monthly compounding. So that's true. So if you have a doubt during an exam or something like this, do not hesitate to write down on your paper, I consider EAR because it's not clearly said that APR should be used or whatever. Okay, so that would not be penalized then because the text is not clear. What I can add to that is that usually in exams or in exercises, usually the normal scenario is that we use APR and then the calculation. Okay, so usually this is what we do. So, okay. Yeah. Super, merci, merci. Thank you. Game on. And so Kian exercise. So I think it's not totally correct. I think we have paying interest for the first part. No, it's a little bit different from that, Kian. I think the principal is 6,140. So I don't have the details of your calculations, but yeah, let me show the solution for the first page. And Trang has a solution for, so yes, this is correct. Bravo, Trang. This is correct, what you have. I give 5 more minutes to everyone and I give the solution for this exercise, okay? So here it's correct. Sorry, my sorry if for the mistake about your name here, because um, it's correct. So it's because yeah, I don't know, but hier in French means yesterday. So my chat is correcting automatically. Yeah, yeah. So that's why I'm sorry. Um, you are not a man of yesterday. You're more for tomorrow, right? You're a person for tomorrow. Okay, so we had other answers from Kiem, which is correct as well, and Ha is correct as well. Okay, so I think it's time to discuss the solution. So you have it actually on the screen. Okay, so I don't present Excel. Huh? I prefer to stick on the screen, so we save a little bit of time. Okay, so you just purchased the home, taken out 500,000 mortgage. The mortgage has 30-year term with monthly payments, APR 6%. So you understand the questions. How much interest and much principal during the first year? So maybe you realized when you do it by yourself, but this first question is a little bit easier than what we did, because the first year, of course, we have one calculation less to do because we know already the present value at the beginning of the first year, right? Because this is the amount we borrowed, okay? So firstly, we need to calculate the constant monthly annuity. Okay, so that's using the constant annuity system. Okay, and so we have 2997.75. Sorry. By the way, it's used 360. Oh yeah, because we have 360 months. Okay, sorry, I was mistaking with days. No, it's months, because we have 30-year time 12, so it's 360. 360. So this is a monthly annuity we're gonna pay during 360 months. Okay, so every year we're gonna pay 12 times this amount. So we're gonna pay 35,973. And so now our job in question A and B is to split that between interest and principal. So for the first question, as I said, it's a little bit easier because we only need to calculate PV after 1 year. PV after 1 year. Again, if you remember well, the present value of the loan after 1 year, we paid 1 year. So it's the present value of 29 years to go. So that's why we got 308 and 48 for the exponents, because it's 12 times 29. Okay, so it means that after 1 year we have left 493 860 for the loan. Okay, and so now we can calculate the principal we paid. Okay, it's 500 minus this amount, so it's 6,140 for the principal. And so we can deduce the interest, because we know, again, and it's important, that the total payment of 35 are made of only two things, interest and principal. So since we know that the principal is 6,140, we can deduce that the level of interest is the difference between the total amount we pay, 12 times the annuity, minus the principal. So it's 29,833 for interest in the first year. Okay. And so now for the question B, it's more the same way than what we did at the beginning of the class. We have to firstly realize when we are in time. Okay, so we are between, but it's said in the case, it's between year 19, year 20, okay? But sometimes it's not said, right? So you have, when you say during the 20th year, so you have to mention, okay, what is the beginning and the ending time? Be clear about this if you have that in an exam. So it's say PV after 19 years, PV after 20 years. So at least if you do a mistake, you know, we can see, I can follow your logic and give you some marks. That being said, so we have to calculate the present value at the beginning of the period we analyze at the end. So after 19 years, so again, if it's after 19 years, it means that we have 11 years to go. So 11 years times 12, so 10 times 12, so it's 120 plus 12, 132, 11 years. And after 20 years, where of course it's going to be, the exponent will be 12 months less, right? So now it's 120 instead of 132 because it's 1 year later. So after 20 years, we only have 10 years to go, so 120 months. So we can calculate the present value of the loan after 19 years, after 20 years. So of course it goes down, right? Because we pay a part of principal. So after 19 years, we still have to pay 289. After 20 years, we have to pay 270. So the difference is 19. Okay, so during the year number 20, we pay back 19,144 in principal. And so again, remember that the total amount we pay, 35,973, which is made of 12 times the annuities, it's made only of two things, interest and principal. So we deduce the level of interest. Okay, and just to close up this example, just want to show you that, of course, the first year we pay 6,000 of principal, and the year 20 we pay 19,000 of principal. So it means that, of course, with the years passing by, you pay more and more principal each year. So that's why we say that in the constant annuity system, you pay more interest at the beginning of the loan. Okay, we have the illustration of this. We pay only 6,000 of principal the first year, 19 of principal during the year 20. And of course, on the contrary, we pay more interest year 20 than year 1. So in year 1, we pay less and less interest with the time. So the first year we pay 29, nearly 30,000. And we can see that we pay only 16,000 or nearly 17,000 of interest during the year 20. Okay, so calculations is one thing. And then maybe, please do remember that in the constant annuity system, with the years passing by, we pay more and more principal and less interest, of course. Okay. Do you have any question about the exercise number 6 in the chat? If not, you can move to the exercise number 8, for which I have already some he and who answered. Okay, so the exercise number 8 is, I like it because it shows if you have well understood. Okay, so this time the mortgage on your house is 5 years old. It requires monthly payment of 1,402. Had an original term of 30 years, an interest rate of 10% APR. Okay, so please use the APR in the calculation. In the intervening 5 years, interest rates have fallen. Okay, so that's the situation we have today. And so we decide to refinance. So we roll over the outstanding amount in a new mortgage with a new rate, because the rate now is 6.6625%. Okay, so instead of 10%. So we renegotiated with the bank, so we have a better rate. Okay, so we have different situation. It's like you are in the office of the bank. The first thing is that, okay, if you decide to take a new loan for 30 years now, what monthly payment will you require? So it means that you would like to diminish your monthly payment. Second scenario, you for the new mortgage, you want to keep 25, okay? Like you had 25 left. So what monthly payment? Now you say you want to stick the same amount that you pay today after refinancing, meaning that you want to make an effort to still keep on going paying what you pay usually, but with the better conditions. So maybe you're going to save some time. So how long will it take you to pay off the mortgage after refinancing? And then suppose you are willing to continue making monthly payments for the same amount and you want to pay off the mortgage in 25 years, how much additional cash can you borrow today as a part of refinancing? Okay, so I'll let you work on this and I'm gonna have a look at the solution which are already in the chat. So congratulations to the students who already advanced. By the way, I didn't mention that, but for the final exam, any type of calculator is allowed. So if you have a financial calculator, it's okay. Okay. The only thing you cannot have for the exam is a calculator which has a paper print part, but scientific calculator or financial calculator is okay. So Hien, so let me check for your answers. Okay, okay. I got a number of months when you have a number. Okay, so it's all correct. So I guess for the, so I've got 170 months. So I'm talking to Hien in the chat. So all your answers seems to be correct. I don't know for, I have got 170 months instead of 14.15 years. I see a new message, but I check as Tuan Han has been doing. Okay, that's correct. Tuan Han, that is correct. So I think there is a joke by Luang because I think maybe the students who are answering in the chat are from Ho Chi Minh City Group. Is that it? That's why you say Fast and Furious. So you are competing with your colleague in Hanoi. Is that it? So if there's someone in from, so is that it? Like are so group one must be from, yeah, group one, group two are from Ho Chi Minh City because this is Miss Tram who gave the number to the yes, that's it. Okay. So we need some Hanoi students to find the right answers very soon, so you can, answer to that challenge from your colleagues from the south, to show to them that you can be fast and furious as well. I know you can be because I'm there. So last year I was on a motorbike with one of the students during, what was it, like the Suzuki Cup final that you guys won. We were in the city. I was trying to reach my hotel back. Took hours to go back to the hotel after the victory, right? It was very fun to be there. Yeah, you need some warm up. I know Hanoi is more like, time for warm up and, but I know usually there is no difference between the two cities in terms of performance. So I'm not judging, right? It's not the fastest who wins anyway. It's just a matter of understanding the topics. So everybody has its own rhythm to understand the topics. The winner is the one who learns. So that is correct, Chang. We have a little bit of a difference. You have 990 and I have 987. So for me, maybe Chang, try to check if you took 0.5521. My my intuition is that maybe you took 0.55. So that's why you have maybe a difference of $3. Okay, so Chang, that would be correct for the exam. Okay, I would not penalize this. Okay, because of course you understand the topic and you do rightly the calculations. Okay, so I would not penalize this. So, but my advice is that when you have rates like this, monthly rates, maybe keep four figures to be so to be more precise, as we can see. And so that's for everyone, not only for Chang, but Chang is correct. The result is 990.88, okay, and I have 987, okay. So we can see that we have $2 or $3 of difference because Chang took 0.55 instead of 55.21. So when I was saying to you, maybe try to keep four figures after the dot, you can see the difference that it makes. It's no big deal. It's a question of $2 or $3. But if you want to be more precise, please keep four figures after the dot. So of course, because you can use any type of calculator during the exam, it means that you will have also questions which are not so easily to solve with financial calculators, like qualitative questions you have to answer to, or for the NPV calculation, you cannot really use the thing. So no, you need to you need to, yeah. So that's all the thing too. You need to detail the formula you use to show to me they understood the way it works. Okay, if you have only the answer, maybe you will not have all the marks, because I need to see you understood. So try to find a balance between, okay, if you have the calculator that is helpful for you, good for you, but try to write the formula, try to say it's a constant annuity, so we use this formula, okay. And you don't need to write a book, right? But at least a few explanations to show that you understand the, yeah. So to show that you your calculator is just a tool for you, but your brain is understanding what you're doing. Yeah, so a balance between the two. Okay, so let's say 5 more minutes and I show the solution. Okay. Yes, that's correct. For the first question. Yeah, that's correct also for the second question. Okay, I'll let you 5 more minutes, okay? Because I see that some of the people who are sharing answers are sharing answer for question A on B or something like this. So I want you to have 5 more minutes, okay? To then I correct. Okay. So I think it is time now to I see more of students who finished, so I think it's time. So this exercise is good training also for the exam. You will see when you see the final exam that I will share with you from a previous year. There's something like this. I like it because I like this kind of exercise because it shows quite well if you understood the time value of money, the context of rates as well. And so for me, it's good feedback to see if you understood well the fundamentals of what you need to know. So let me tell you the story of this solution. So again, you could really imagine that you are in the office of your bank advisor, your bank. I mean, you are in your bank and you would like to borrow the money, okay? Or you borrowed the money 5 years ago. 5 years ago, actually, we don't know the original amount we borrowed, but we don't care because we are just now. And so, what we need to know now is, firstly, the outstanding balance of the mortgage. So what is the amount left after 5 years? Because we have 5 years later. Okay. So we know that it was 30 years at the beginning. Okay. So it means that we have 25 years left, meaning 300 months with an APR of 10%. So please use monthly APR because we have monthly payments. Okay. Um, of 1,402. So it means that um, it means that we can calculate the present value of the loan, the outstanding balance of the loan after 5 years. So we have 25 years left, so 300 months, okay, with, sorry, a monthly annuity of 1,402 and a monthly rate, monthly APR of 0.8333%. Okay, so it means that at that moment, the remaining amount of our loan is 154,286. This is the amount we still have to pay. Okay, so that's the first step. And now from there, we are negotiating with the bank about how we can organize our life now, knowing that the rate which is available on the market now is lower, 6.625. Okay, so the first thing is, okay, let's say that I don't know, maybe there is a crisis, COVID crisis, one member of the family lost his job, and so we don't have a lot of money, so we would like to go back to 30 years, okay, but for 154, but with the new rate, okay. And so doing so, we have, okay, the new rate then is 6.625 divided by 12, so 0.5521, okay. And so we go back with 360 months, okay. So it's even longer because we had 30 years at the beginning, we have 25 years left, and then we go back to 30 years. So of course, the monthly annuity is lower because the rate is lower and we go back to 360 months. So we pay 987.93. We could maybe imagine that even we are being saying to the bank, we cannot afford to pay more than $1,000. So if we go 30 years, how much is it? Well, it's 987. Okay, so that's good. We can afford that now only with one salary in the family. And we see later if we want to go more. Okay, so that's the first scenario. The second scenario, if you say, okay, you stick to 25 years. So you are in the office of the bank, you say, okay, we want this better rate, but we want to keep the same number of periods to pay. So it's 25 years. So in that case, we have 300 months, okay? 300 months, sorry, I don't manage to underline that in yellow, but you understand. 300 months, and so now the monthly annuity is 1,053, nearly 1,054. Okay, so in that case, you just keep on going with the same schedule, 25 years to go, but you have a better rate. So instead of paying 1,402, you pay 153. Okay. As you said, in the US, one of you said that earlier, compared to Vietnam, in the US, there is no penalty, you know, for you know, things like this. So it's quite interesting to do so because you don't have special fees at that time. So that makes sense. Okay. Of course, you got limits, right, to about what you can do, but still. So question number C. So you want to stick to the 104,402 and with the new rate. Okay, so you got the new rate. You want to keep 104,002. This is what I would do in me personally, if I want to borrow money and have this situation, this is what I would like to do, because I don't know for you guys, but I would say to myself, okay, I got used to pay 1,402 every month. So, you know, my life is organized with that budget. So I know I can afford to pay that back, but I want to benefit from a better interest rate. So, you know, okay, I keep 1,402, but with a new rate. So it means that I'm gonna, you know, save some months, right? So how many months now I will have to pay? So it's going to be 170 months instead of 300, right? I think it depends on, but 300 normally. Okay, so that's very good. Huh? It means that you're gonna save a few years on your loan. So this is exactly what I would like to do as a person when I do a loan. If I have the opportunity to pay back earlier, I will always. And then now, next scenario: suppose you're willing to continue to pay the amount, but you want to let's say borrow more because you have a new project. Like, for example, you have an apartment and you would like to buy a garage for your car, or I don't know, to buy an extra land because you have now several kids, and so you would like them to have an extra garden to play in or something like this. Okay, so you have this situation. So here we find that the extra money we can find is 50,969. Okay, so that's a very good exercise to train with. So I don't know if you have question in the chat for me or information about this one. Good training, and you will see when I share with you final exam from a previous year, you will have an additional training with another exercise. So again, I like this kind of exercise, so keep that in mind. Okay, so we still have a few minutes left, so I would like to take the opportunity to move to the next chapter, if I may. We got 15 minutes left. So I would like to begin the chapter about the bonds. Okay, so we can, we are not running late for anything, so we are keep on tracking for the different chapters. So of course I'm gonna just say a few things because we got 15 minutes left. So, but this is the next point we're gonna study together. It's the bond valuation. Okay, bond valuation. So it's chapter 6 from the book, firstly. So if you want to know more, I know that usually there are some students who work in the bond market. So usually I have 2 or 3 people who know better than me this chapter. So do not hesitate to share with me your personal experience in the chat so other students can benefit from it as well. So we're gonna just discuss the basics here. You will discuss more details of this later during the MEBF, during the second year of the MEBF, with people like Michael Trugger from ESCP or Didier Marteau, who are more market finance specialists. I'm not a market finance specialist, I'm more a corporate finance specialist, along with a CPA diploma, so I'm very, corporate focused. But still, as a corporate finance person of a company, maybe you will have to, to issue a bond, a bond loan, or you will have to buy some bonds because you have extra cash, and you need to know the basics. So firstly, let's talk about vocabulary. Okay, it's just to agree on terminology. So a bond is a piece of a loan, right? It's like when you are a company, you can choose to go on the bond market to borrow money through a bond through bonds that you issue. Okay, so it means that you will need to have a contract with the people who are buying the bonds, because on one side of the mirror you have people who would like to buy bonds because they want, they want to earn some interest without taking too much risk. A bond is certainly less risky than a stock, for sure. And on the other hand, the company who's going to issue the bonds, they want, to gather money to, to finance projects, but they will have to pay back also as well. So both sides of the mirror, they need a sort of a contract, right? So of course there is not a contract for every person, right? But you have what we call a certificate. So it's like, of course, on the markets, you will have, as a company, to discuss the information about what are the different elements of this contract between you and the bond buyers. Okay, so the bond certificate will summarize the characteristics of your bond. that you issue. Okay, so everyone knows, and of course it's also for you, it's a promise you make and that you will have to respect. And if you don't respect, of course the financial authorities will be able to come to you to say, hey, you promised that in the certificate, so now you have, to keep your promise. So among the different characteristics of a bond, you will find in the certificate the maturity date, of course, meaning the number of years of the bond loan. Okay, is it 10 years long? Is it 20 years long? Okay, and so you will have also the final repayment date. You will have what we call the term is when you are during the life of the bond. It's the number of years you still have left till the maturity date. Okay, so let's say that you issue a bond for 20 years. So the maturity date will be in 20 years. And the term is at the time is 20 years. But 5 years later, the bond still exists and the term is, 15 years still to go till the end. The coupon is the interest in the context of the bond. Okay, so it's also for me to say that when we talk about stocks and bonds, which are the two next chapter we're going to study together, we're going to very much use what we did in the time value of money chapter. So that's why it was so much important, this chapter, for you to understand, because we're going to use the same mechanics for all the chapter following. It's just then maybe to some extent, it's just the vocabulary that's going to change. Okay, like for example, interest in the context of a bond, it's going to be called a coupon, right? Why? Because historically, the bond was a physical piece of paper, right? And so you were holding the bond because you were the owner of the bond, okay, because everything was materialized, there were no computers, right? And so the coupon, which was a promised interest, was something you could cut from the bond every year. You had the number of the bond, you have the year of the interest, and you could go and say, okay, if I own this piece of paper, it means that you have to pay me the interest. So it's not physical anymore, the bonds, but of course the vocabulary remained the same. Then we have also what we call the face value. The face value of the bond is the usually the value that you're gonna pay to buy the bond. Okay, that's true that in reality sometimes you will have some premiums. So you will have a face value of 100, but the bond will be issued at you will have to pay only 895 to buy it, because they try to create incentives for you to buy, so they give you a premium, okay, for the buying of it, and sometimes at the end they will pay you back a little bit more than 100, maybe 105. Okay, so have a premium to create an incentive for you to buy it now. So it's an extra return for you, an extra earning for you. But in a typical situation, the bond will be issued 100, so you will pay 100 to buy it, okay? And also what is important to remember is that the face value of the bond, okay, is also what will be used to calculate the coupon, okay? So the coupon will be equal to what? Face value. So coupon, let me remind you again, huh? The coupon is the interest rate. The coupon is the interest you receive, okay? So the coupon will be equal to what? Face value times the coupon rate, okay, so interest rate, divided by the number of coupons payment per year. So the way the formula is written here, it means that we have an APR approach, right? Because we divide the coupon rate by the number of payments during the year. So this is exactly what we do when we use the APR. So it means that in the context of the bond, we will use an APR approach with the coupon rate. Okay, so that's important also for you to remember. Then we have two types of bonds. We have zero coupon bond, and we have later coupon bonds. Okay, so please remember that we're going to discuss together two types of bonds. The normal ones, the one you can easily imagine, the bonds for which you receive a coupon every period, maybe every year or every 6 months. Okay, so that's the coupon bond. But we will talk about that only later. Please notice that you have another type of bond, which is maybe less intuitive for you to know, which is what we call zero coupon bond. So these are bonds that do not pay coupons. Okay, they don't pay interest. So question is, why would you buy that, right? If you don't receive any interest, it's useless. Well, these products exist really, okay? So it means that there is for you a good reason to buy it. Well, of course, the only reason is that the price you pay at the beginning is lower than what you receive at the end, okay? So zero coupon bond do not pay any interest, any coupon at regular moments. So if you want them to be attractive for people who buy it, you must sell them at what we'll call a discount. So it means that the price people will pay to buy it is lower than the face value. Okay, so let's say that you have a zero coupon bond which has a face value of 100. Okay, so the price on the market to buy it will be maybe $90. Okay, so you know that you pay 90 today, you receive 100 in 1 year or 2 years, whatever, depending on the maturity of the bond. Okay, and so of course for you it's like saving money, right? Because it's like you put some $90 on your saving account, and after 1 year you have 100. Okay, so again, this product exists really. It's, for example, the treasury bills of the US government. They are zero coupon bond with a maturity up to 1 year. Okay, so for example, here we have this coupon, this bond. Okay, so the face value is 100,000. Okay, and the initial price you pay is 96,618.36. Okay, so you pay 96 and you receive 100 in 1 year. So how do you measure the earning of your bond? Is of course with the discount rate you're going to use to go from 96 to 100. Okay, so the return for you of your investment will be this. What is the rate when I do 96,618 times 1 plus r that leads to 100? Okay, so this is how you calculate the return of your bond. And this is what we call, in the context of the bond, the yield to maturity. Okay, so the yield to maturity is the return of a bond. Let me say it again. The yield to maturity is the internal rate of return of a bond. Okay, you remember we talked about the internal rate of return. If you remember, it was 14.28 for, the construction project we had the first day together. And we say this is a real return we have on this project. This is the internal rate of return, IRR. So in the context of the bond, the IRR is called the yield to maturity. This is the return you earn from that investment. So in your zero coupon bond, you receive 100,000 in 1 year, divided by 1 plus R, it's 96 today. So it means that the YTM of your investment is 3.5. This is a discount rate you had to use to go from 96 today to 100 in 1 year. Okay? So just to finish with today, you have this problem, 6.1, and I would like you to try to calculate the yield to maturity of these different bonds, okay? So you got bonds which have a face value of 100, okay? So this is what you receive, but you will receive it in 1 year, 2 years, 3 years, or 4 years, respectively, okay? So the 1 year, we can see 96.62. This is the one we calculated here, okay? This one, 3.5. So the answer to this first question here is 3.5. Now I would like you to try to calculate the YTM of this bond 2 years, 3 years, and 4 years respectively. Okay, so this is what I would like you guys to do for tomorrow. And if you do not have any other question, it's time for me to let you to let you enjoy the rest of the Sunday before you get back to work tomorrow morning. So thank you for being so brave and taking the MEBF. I'm always very admirative of you guys who are working on at nights and evenings, so you have a better diploma and a better career. So I know it's not so easy. Yes, I know, too late to enjoy. So maybe rest well, right? Rest well. What the difference between paying a coupon and selling at a discount on a bond? Well, I keep that for tomorrow. Okay, so can you say that for me tomorrow? So Tong, I will. So please ask me the question again tomorrow. Okay, and we will rediscuss this. Okay. So I will begin tomorrow by explaining difference between zero coupon bond and coupon bond. I think it should answer to the question. Okay, so good luck for everyone. My best wishes for tomorrow, everyone. And thank you for your attention. And good night. And see you tomorrow, 7 p.m. Okay, thank you, everyone.